The Indian Stock Market Simplified by Anant Lidha and Pankaj Lidha. Intro. This is not just about stocks. It is about dreams. It is about choices. It is about understanding the game before you play. The Indian stock market can feel like a puzzle. Numbers, charts, jargon. It can make you feel small. But it does not have to. You can walk into this world with clarity, with confidence, with a map in your hand. The Indian Stock Market Simplified by Anant Lidha and Pankaj Lidha is that map. It breaks the market into pieces you can hold. It removes the fog. It replaces fear with awareness. Today, we will walk through its lessons together. One chapter at a time. You will not just hear about stocks. You will feel why they matter. You will see how they can shape your life. Let's start. Chapter 1: The Story and Structure of the Indian Stock Market. The market has a history. It didn't appear by chance. It grew from small trades, to public auctions, to digital platforms. India's stock market reflects its economy. It reflects people's trust. It reflects business growth. First, you need to see the frame. Then you build inside it. Two main exchanges. There are two big marketplaces. The Bombay Stock Exchange (BSE), one of the oldest in Asia. It started with traders under a banyan tree. Then it formalized. The National Stock Exchange (NSE), built later with technology focus. It brought transparency. It brought speed. Together they host most Indian equity trading. They list companies. They match buyers and sellers. They turn ownership into price. What is a stock? A stock is a piece of ownership. When you buy a share, you own a part of the company. You share its profits. You share its risks. You become a stakeholder. You get rights, voting, dividends, and information. The market gives you a price. That price moves with demand and supply. Who watches the market? SEBI is the guardian. It stands for Securities and Exchange Board of India. It creates rules. It protects retail investors. It prevents manipulation. It makes disclosure mandatory. It tries to keep things fair. That's why regulations matter. They build trust. Settlement and clearing. Trading is one thing. Settlement is another. When you buy a stock, you don't get it instantly. When you sell, you don't get money instantly. There is a short process. It's called settlement. India moved to faster settlement. Equity trades settle in T+1 now. That means the transfer happens the next business day. Behind the scenes, clearing corporations work. They guarantee trades. They reduce counterparty risk. They manage the flow of shares and cash. Dematerialization. Shares used to be physical. Paper certificates. They caused delays. Now all shares are electronic. They live in depositories. Two big ones, NSDL and CDSL. They hold your shares digitally. You get a Demat account. It links to your broker. Buying and selling becomes smooth. No lost certificates. No long paperwork. Market segments. There are different playgrounds. The cash segment. You buy and hold. The derivatives segment. You trade futures and options. There is commodity trading too. And currency markets. Each has its own rules. Each has its own risks. Understanding the segment is step 1 before entering. Price discovery. Price is not random. It comes from many voices. Buyers bid. Sellers ask. Orders stack in the depth. The best price matches first. This gives you the current market value. Volume shows conviction. Higher volume means more belief. Low volume means quiet doubt. Indices. Indices measure the market's pulse. Sensex, Nifty. They are baskets. They hold top companies. When they move, large slices of the economy move. They help you see big trends. They help you compare performance. You don't need to watch every stock. You can watch the overall health. Market capitalization. It is size measure. Price times total shares equals market cap. Large cap, mid cap, small cap. Each behaves differently. Large cap is stable. Small cap can swing more. Risk and reward shift with size. Circuit filters and safeguards. The market has brakes. When a stock jumps too fast, movement is paused. When it drops too deep, trading slows. These are circuit limits. They prevent wild panic. They give time to breathe. Trading hours and rhythm. The market opens. It closes. There is pre-open. There is closing call. Each hour has its mood. Morning can be volatile. Afternoon can settle. Knowing the rhythm helps you avoid surprises. Role of brokers and technology. You need a bridge. Brokers connect you. They give access. Technology runs the show now. Apps, order types, real-time quotes. You can place limit orders. You can set stops. You can track your portfolio live. The book simplifies all this, so you don't get lost in jargon. Public participation. Retail investors are growing. More people are joining. Demat accounts are increasing. Access is easier, but ease brings temptation. That's why foundation matters. You need to know structure first. Then you decide where to step. Why this chapter matters. If you skip the basics, you build on sand. You will react to noise. You will follow wrong signals. If you learn the system, you build from the ground up. You know who does what. You know where your money flows. You begin with context. You trade with clarity. Quick checklist before moving on. Do you know the difference between NSE and BSE? Do you understand what a share means? Do you know who regulates the market? Do you know how settlement works now? Do you have a demat account idea? Can you explain what an index is? Have you felt how price is discovered? If yes, you're ready for the next chapter. If not, pause. Review. Foundation first. Chapter 2. Who are the players? The market is not a lone voice. It is a crowd. Each player has a role. Each has a motive. You need to see them clearly, so you don't get pulled. Retail investors. That's you and me. We bring our savings. We bring hopes. We often come with emotion. We can be powerful, but we can also be noisy and reactive. We buy on tips. We sell on fear. The book tells you, slow down. Understand before you act. The smart retail investor watches the others, but does not blindly follow. Institutional investors. These are big money. Mutual funds, insurance companies, pension funds. They move large blocks. They have research teams. They have long horizons sometimes. They also have mandates. They can influence price. When they buy, volume spikes. When they trim, markets feel it. Retail watches them, but institutional moves are not always right. They have pressure too, from clients, benchmarks, flows. Foreign institutional investors, FIIs, foreign portfolio investors, FPIs. They bring global capital. They can flood in. They can pull out fast. Their money chases trends. They watch global cues. Sudden foreign outflows can shake markets. The book shows how to interpret their flows. Not to copy blindly, but to see where sentiment is. Brokers. They are the bridge. You place the order. They send it to the exchange. Some are full service. Some are discount. Some give advice. Some push products. Know their incentives. Some earn when you trade more. That can work against you. The book teaches you how to choose and how to not fall for flashy calls. Market makers, liquidity providers. They keep the show running. They quote buy and sell. They narrow spreads. They absorb temporary imbalances. Without them, the market would stall. Sometimes they slow down extreme moves. Sometimes they pull price around to test demand. Watching how price behaves near their zones gives you a clue about real interest. Analysts and research houses. They write reports. They give target prices. They grade companies. Some are independent. Some are tied to brokers or investment banks. Their words influence money. But remember, their model has assumptions. Their recommendations are opinions. Use them as input, not as gospel. The book teaches how to read between the lines. Promoters and insiders. They started or control the company. They know more. Their actions speak loud. When they buy, confidence rises. When they sell heavily, alarm bells ring. But sometimes they sell for personal reasons. The book helps you differentiate between strategic selling and selfish exit. High net worth individuals, HNI, wealthy investors. They get access. They get early offers. They have relationship channels. They can move markets in pockets. They often co-invest with institutions. They sometimes get private deals. The retail investor can learn from their patterns. But they also act on information not visible to you. So don't imitate blindly. Algorithmic traders, HFT, high frequency trading. They trade with speed. They use computers. They sniff order flow. They make micro profits in milliseconds. They can cause short-term spikes. They can push price around briefly. They are not making long-term bets. The book tells you, don't get whipsawed. Watch big trends. Not every twitch. Clearing corporations and settlement infrastructure. They work behind the scenes. They guarantee the trade. They settle the money. They reduce counterparty risk. Without them, trades would be fragile. They make sure your buy becomes share, and your sell becomes money. The book simplifies their role so you value security, not just execution speed. Custodians, depositories. Your shares live somewhere. They live electronically now. NSDL and CDSL hold them. They keep them safe. They link through your Demat account. You don't have paper risk anymore. Understanding custody avoids fraud. The book makes this feel easy. Advisors, financial planners. Some help with strategy. Some sell products. Some wear both hats. Good ones ask questions. Better ones listen first. Bad ones push what earns them commission. The book gives you questions to separate advice from salesmanship. Regulator, SEBI. They are the referee. They set the rules. They ban unfair practices. They mandate disclosures. They try to balance fairness and growth. When regulations change, markets adjust. Knowing why rules exist keeps you safe. Media and influencers. They amplify stories. They create urgency. They sell fear. They sell trends. Some inform. Some hype. The book warns. Don't react to noise. Filter what matters. The interplay and conflict. Not all players want the same thing. Some push price up to sell. Some hold silently for years. Some create temporary panic. Some build real value. Your job is to listen. Understand the motive. Then act. How retail gains clarity. Watch volume. Watch who is buying and selling. Read shareholding patterns. See promoter action. No institutional flows. Listen, but don't copy. Use others' moves as context, not as commands. Mini story. Ravi was new. He followed a hot tip from TV. He bought a small company. Institutional money was exiting quietly. He didn't see it. Price dropped. He panicked. He sold low. Years later, he learned to read the players. He started watching fund holdings. He saw when smart money accumulated. His decisions changed. His outcomes improved. Checklist before moving on. Do you know who buys big? Do you know who sets the price rhythm? Can you tell the difference between hype and institutional accumulation? Do you watch insider action? Do you filter advice from pushing? If yes, you've gained an edge. If not, pause. Learn the players again. Chapter 3, Setting up Demat, Trading Accounts and KYC. Before you buy your first share, you need the tools. A carpenter needs his hammer. A driver needs his car keys. An investor needs his accounts ready. The two core accounts. You need a Demat account. You need a trading account. They are different. They work together. Demat account. Demat means dematerialized. Your shares are stored electronically. No paper certificates. No risk of losing them. The Demat account holds your stocks. Think of it as a locker. You can open it with NSDL or CDSL. Through a broker or a bank. Trading account. This is your gateway to the exchange. It connects you to NSE or BSE. You place buy and sell orders here. Without a trading account, your locker is useless. Without a Demat account, you have no place to store what you buy. Bank account link. Both these accounts are linked to your bank account. This allows money to move in and out for trades. Profits and investments flow seamlessly. KYC, know your customer. KYC is the ID check. It proves who you are. It is mandatory by SEBI. You need to submit your PAN card, proof of address, photographs, sometimes income proof. For online accounts, this can be done with AKIC, using Aadhaar OTP. The step-by-step process. Choose a broker, full service for guidance, discount for low-cost execution. Fill account opening form, can be online or offline. Complete KYC verification. Sign agreements. Digital signature in online setup. Link your bank account. Get your login credentials. Download the broker's app or trading platform. Test with small trades first. Choosing a broker. Look at charges. Look at service quality. Look at ease of use. Check if they are registered with SEBI. Check reviews. Don't choose only on cheapest fees. The right platform matters when the market moves fast. Security measures. Always use two-factor authentication. Never share your login ID or password. Check contract notes after trades. Monitor account statements regularly. Mini case study. Priya rushed to start investing. She chose the first broker ad she saw. She didn't check charges. Hidden fees ate into her profits. She didn't enable 2FA. Her account was compromised. After loss, she started over carefully. She picked a SEBI-registered broker. She read the terms. She secured her logins. She never faced the same trouble again. Checklist before placing your first trade. Check mark Demat account active. Check mark trading account active. Check mark bank account linked. Check mark KYC done. Check mark login secured. Check mark charges understood. Check mark platform tested. Why this chapter matters. Without setup, you are not in the game. With poor setup, you are playing on a weak foundation. This chapter makes you ready. Not just to trade, but to trade safely. Chapter 4, Fundamental Analysis. Reading the business. A stock is not just a number. It is a living business. Behind the ticker symbol, there are people, products, and profits. If you don't understand the business, you don't understand the stock. What is fundamental analysis? It's the process of judging a company's true worth. Not by the market's mood. Not by daily headlines. But by the company's own performance and potential. It asks, how healthy is this business? Will it grow? Is it worth my money? The core purpose: to separate strong companies from weak ones. To pay a fair price for real value. To avoid hype. To avoid traps. Step 1. Understand the business model. What does the company sell? Products, services. Who are the customers? Why do they choose this company? Is demand stable or seasonal? Can new competitors take market share easily? The stronger the model, the stronger the future. Step 2. Study the financial statements. There are 3 main ones. Income statement shows revenue, expenses, and profit. Is revenue growing steadily? Are profits consistent or volatile? Balance sheet shows assets and liabilities. Does the company own more than it owes? Is debt under control? Cash flow statement shows actual cash movement. Is the company generating free cash flow? Profits mean nothing if cash is stuck. Step 3. Key ratios to watch. Earnings per share (EPS) is profit growing per share. Price to earnings (PE) is the stock overpriced or underpriced compared to peers. Return on equity (ROE) is management using shareholders' money effectively. Debt to equity is the company over-leveraged. Operating margin, how much profit is made after covering core costs. Step 4. Management quality. A great business with bad leadership will sink. Check the track record of promoters. Do they have skin in the game? Are they honest in communication? Have they faced fraud or penalty in the past? Transparent management builds long-term trust. Step 5. Industry and moat. How big is the market? Is it growing? Does the company have a moat? Something competitors can't easily copy. A moat could be brand loyalty, cost advantage, technology, or regulation. Step 6. Valuation. Even a great company can be a bad investment if you pay too much. Compare the current price to intrinsic value. Intrinsic value is the fair worth of the business, based on earnings and growth potential. If price less than intrinsic value, you have a margin of safety. Mini case study. Ravi bought a stock because a friend said it was hot. He didn't check debt levels. He didn't see that profits were falling. Within months, the company defaulted on loans. The stock crashed. Anita took time to study a consumer goods company. She checked 5 years of financials. She saw consistent profit growth, low debt, and strong market share. She bought during a market dip. 3 years later, the stock doubled, and she kept collecting dividends. Why this matters? Fundamental analysis protects you from emotional decisions. It helps you think like a business owner, not a gambler. When you know the business, you hold through fear. You sell when the story changes, not when the price wobbles. Checklist before buying any stock. Check mark: do I understand the business model? Check mark: have I studied at least 3 years of financials? Check mark: is management trustworthy? Check mark: does the company have a moat? Check mark: am I paying less than intrinsic value? Reminder: the market rewards patience and preparation. Price is just the surface. Value is underneath. Learn to read it. Chapter 5. Technical analysis. Reading the price. Every stock has a story. Fundamental analysis tells you the business story. Technical analysis tells you the market story. It's the language of price and volume. It shows what buyers and sellers are doing right now. Why technical analysis matters. The market doesn't always follow logic. Sometimes price moves ahead of news. Sometimes it ignores good fundamentals. Charts capture behavior. They reflect greed and fear in real time. Learning to read them gives you timing and clarity. Price is memory. Every tick is a deal between a buyer and a seller. Those deals leave a trail. That trail is the price chart. It shows where the market got excited. It shows where it got scared. It shows where it paused. Support and resistance. Support is where price finds buyers. It's a floor. Resistance is where price finds sellers. It's a ceiling. When price breaks above resistance, that ceiling can become a new floor. When price breaks below support, that floor can turn into a ceiling. These levels are not magic. They are just areas where psychology repeats. Trends. The market moves in trends. Uptrend, higher highs, higher lows. Downtrend, lower highs, lower lows. Sideways, price stuck in a range. Identify the trend first. Trade with it, not against it. The trend is your friend. Until it ends. Volume. Price tells you direction. Volume tells you conviction. A big move with low volume is weak. A big move with high volume is strong. Volume confirms the trend. Candlestick patterns. Each candle shows the battle between buyers and sellers. Green means buyers won that period. Red means sellers won. Shadows show how far each side pushed. Patterns like doji, hammer, engulfing tell you about indecision, reversal, or continuation. The book simplifies these patterns, so you don't get lost in 50 names. Moving averages. They smooth price. They show the bigger picture. A 50-day average shows medium-term trend. A 200-day average shows long-term trend. When the shorter crosses above the longer, it's bullish, called a golden cross. When it crosses below, it's bearish, called a death cross. Indicators. RSI shows if a stock is overbought or oversold. MACD shows momentum changes. Bollinger Bands show volatility. The book warns, don't overload with indicators. Pick a few, learn them well. Chart time frames. Daily charts show medium-term moves. Hourly charts show intraday action. Weekly charts show the long-term story. Choose the time frame based on your style. Investors focus on weekly, monthly. Traders watch daily, hourly. Scalpers watch minutes. Mini case study. Amit liked a company's fundamentals, but the chart showed strong resistance at 500 rupees. He waited for a breakout with high volume. When it happened, he entered. The move was quick and clean. Rohan ignored charts. He bought in a downtrend, thinking it was cheap. The stock kept falling. He was trapped. He learned the hard way that price action matters. Why this matters? Technical analysis is not magic. It's a tool. It helps you see what the crowd is doing. It helps you avoid buying into weakness. It helps you time your entries and exits. Checklist before using technicals. Check mark identify the trend. Check mark support and resistance. Check mark check volume. Check mark confirm with 1 to 2 indicators. Check mark match chart time frame to your goal. Reminder, price is the market's voice. Charts are its diary. Learn to read them, and you'll hear the whispers before the crowd does. Chapter 6, Investing vs Trading. The market offers two main roads: investing and trading. Both can make money. Both can lose money. The danger is when you mix them without clarity. What is investing? It's buying ownership in a business. For the long term, it's believing in its growth. It's holding through ups and downs. It's letting compounding work. Investors think like owners. They ask, is this business worth holding for years? They look at fundamentals. They care about profits, debt, market share. They collect dividends. They sell only if the story changes. What is trading? It's buying and selling. For short-term moves. It's using charts, patterns, and momentum. It's aiming for quick gains. Traders think like hunters. They ask, where's the next move? They don't care about 5-year plans. They care about today's trend. They may hold for hours, days, or weeks. They protect with stop losses. They exit fast if the move fails. Mindset difference. Investing is patience. Trading is precision. Investing requires calm in volatility. Trading requires discipline in execution. Investing makes money slowly but steadily. Trading makes money in bursts. Time commitment. Investors spend more time researching businesses. Traders spend more time watching charts. Investors check portfolios weekly or monthly. Traders monitor positions hourly or even by the minute. Risk profile. Investing risk is tied to business performance. Trading risk is tied to market timing. Investors can recover from dips if the business is strong. Traders must cut losses quickly or risk big damage. Capital approach. An investor may put large amounts into a few quality businesses. A trader may spread capital across multiple short-term setups. Investors may not use leverage. Traders sometimes use it carefully. The trap. Many people buy as investors, but panic sell like traders. Or they trade but hold losing positions like investors. This mismatch is deadly. It confuses your strategy. It turns discipline into chaos. Mini case study. Neha bought a stock for long-term growth. After a small dip, she panicked and sold. She missed the 200% rise over 5 years. She acted like a trader without a trader's plan. Karan planned a quick trade. It went against him. Instead of cutting losses, he kept holding for months hoping it would recover. It never did. He acted like an investor, but chose a bad business for the long term. Can you be both? Yes. But you need separate capital, separate accounts, and separate rules. Never mix money or mindsets. When you invest, follow investment rules. When you trade, follow trading rules. Checklist before you choose. Am I patient enough for investing? Am I disciplined enough for trading? Do I have time for charts daily? Do I enjoy studying businesses? Do I know how much risk I can take? Reminder: the market pays both investors and traders. It punishes confusion. Choose your path for each rupee you commit. Stick to that path until the goal is done. Chapter 7: Strategies for Growth and Income. The market can make you richer in two ways: by growing the value of what you own, and by paying you income while you hold. Both are powerful. Both can be part of your plan. Growth investing. This means buying companies that are expanding fast. They reinvest profits into growth. They launch new products. They enter new markets. They may not pay big dividends now, because they use the money to grow bigger. Their reward comes when the share price rises over time. What to look for in growth stocks: high revenue growth year after year, rising profits, strong market position, a big future market to capture, innovative products or services, low to moderate debt, leadership with vision. The risk with growth investing: high growth can slow suddenly. A small mistake can hurt the stock price badly. Valuations can be high, so timing matters. You need patience and conviction to hold through dips. Income investing. This means buying companies that pay you regularly. They share profits as dividends, or they make fixed interest payments in case of bonds. It's like your portfolio giving you a paycheck. What to look for in income stocks: stable earnings, long track record of paying dividends, consistent or growing dividend payouts, healthy payout ratio, not paying out more than they can afford, strong cash flows. The risk with income investing: if the company's earnings fall, dividends can be cut. Dividend yield can be misleading. If the share price is falling fast, always check the health of the business first. Blending growth and income. You don't have to choose only one. You can own high growth stocks for wealth building, and income stocks for stability and cash flow. The right mix depends on your age, goals, and risk tolerance. Reinvesting income for growth. If you don't need the cash now, reinvest dividends. Buy more shares. This accelerates compounding. Your portfolio grows faster. Mini case study. Arjun built a growth portfolio in his 30s. He held companies that doubled in value over a decade. By 45, he added high dividend stocks. Now his portfolio grows in value and pays him steady income each year. Checklist for your strategy. Do I want faster capital growth or steady income? What percentage of my portfolio will be growth stocks? What percentage will be income stocks? Am I reinvesting dividends or using them? Have I checked the risk of each stock? Reminder: growth builds your future wealth. Income gives you current stability. When you combine them wisely, you create a portfolio that grows and pays today and tomorrow. Chapter 8: Risk Management and Portfolio Construction. In the market, return is exciting, but risk is real, and risk doesn't warn you before it hits. If you don't manage it, one bad move can undo years of work. The first rule: protect your capital, always. Because once it's gone, getting it back is harder than you think. Lose 50% of your portfolio, and you need 100% gain just to break even. Risk is not the same for everyone. It depends on your goals. It depends on your time horizon. It depends on your ability to handle losses without panic. Knowing your risk tolerance is step 1. Principles of risk management. Position sizing. Don't put too much in any one stock. Even the best company can have a bad year. Diversification. Spread across sectors, so one industry's fall doesn't take you down. Stop loss and exit rules. Decide in advance when you'll cut your losses. Stick to it. Cash reserve. Keep some money aside for emergencies, for buying opportunities in a crash. Avoid over-leverage. Borrowed money can magnify gains, but it can also magnify losses. Portfolio construction basics. Think of your portfolio like a balanced plate. Growth stocks are the main course. Income stocks are the steady side dish. Cash and bonds are the safety net. The exact mix depends on your stage in life. Aggressive portfolio example: 70% growth stocks, 20% income stocks, 10% cash bonds. Suitable for younger investors with high risk tolerance. Conservative portfolio example: 40% growth stocks, 40% income stocks, 20% cash bonds. Better for those near retirement who value stability over speed. Review and rebalance. Markets change. Some holdings grow faster than others. Every 6 to 12 months. Check if your allocation has shifted too much. Rebalance to bring it back to your target mix. The mental side of risk. Managing risk is not exciting. It won't make headlines, but it will keep you in the game long enough to enjoy the rewards. It's discipline. It's patience. It's thinking like a survivor, not just a winner. Mini case study. Sunil invested everything in one hot sector, tech. When that sector crashed, his portfolio lost 60%. He had no other holdings to balance the fall. Meera split her portfolio across consumer goods, banking, healthcare, and tech. When tech fell, the others held up. She lost less. She stayed calm. She even used her cash reserve to buy tech stocks cheap. A year later, her portfolio was stronger than ever. Checklist before you invest more. Is any single stock more than 15 to 20% of my portfolio? Am I diversified across at least 4 to 5 sectors? Do I have a cash reserve? Do I have exit rules? Do I rebalance regularly? Reminder: in the market, your biggest job is to survive first. Growth comes second. A well-built portfolio and a strong risk plan make sure you're still standing when opportunity knocks. Chapter 9: Psychology of Money and Market Emotions. Money is not just numbers. It's feelings. It's dreams. It's fears. The market runs on two main emotions: fear and greed, and both live inside you. Fear. Fear shows up when prices fall. It whispers, "Sell before you lose everything." Fear makes you forget the long-term plan. It pushes you to exit at the worst possible time. Fear can also stop you from investing at all. You stay on the sidelines, watching opportunities pass. Greed. Greed appears when prices rise. It shouts, "Buy more. Don't miss out." It makes you take more risk than you should. It blinds you to warning signs. It can make you believe prices will go up forever. Overconfidence. A few wins can trick you. You start thinking you can't lose. You take bigger bets. You ignore your risk plan. And one bad move wipes out months of gains. Loss aversion. Losses hurt twice as much as gains feel good. That's why people hold losing stocks too long. They wait to get back to even, instead of cutting the loss early. Confirmation bias. You look only for news that agrees with you. You ignore warning signs. You avoid opposite views. This traps you in bad decisions. Herd mentality. It feels safe to do what everyone else is doing. When everyone is buying, you feel smart buying too. When everyone is selling, you feel smart selling too. But the herd is often wrong at turning points. The smart investor's edge. They know emotions are part of the game. They don't try to erase them. They try to control them. They have a plan before the storm. They follow rules when emotions scream. How to control market emotions. Write your rules down, follow them in all conditions. Limit news noise, most of it is designed to trigger emotion. Use position sizing, smaller bets make losses easier to handle. Have realistic expectations, no one wins every trade. Track your own reactions, know your emotional triggers. Mini case study. Anil saw the market crash in 2020. Fear told him to sell everything. But his plan said hold quality, buy more at lows. He followed the plan. A year later, his portfolio hit a new high. Rita doubled her money in a bull run. Greed made her double her positions. When the correction came, she lost more than she had gained. She learned that greed can be louder than logic. Checklist before making any move. Am I acting on data or emotion? Is this part of my plan? What will I do if I'm wrong? Am I ready to accept the outcome calmly? Reminder, the biggest battles in the market are not on the charts. They are in your mind. Master yourself, and you master your money. Chapter 10, Common Mistakes and How to Avoid Them. The market is full of opportunities. It's also full of traps. Most people don't fail because they can't pick a good stock. They fail because they repeat the same mistakes. Let's expose them, so you can avoid them. Mistake 1, no clear plan. You enter without a goal. You don't know why you bought. You don't know when you'll sell. Without a plan, you react to every price move. How to avoid it? Write down your purpose, holding period, and exit rules before you buy. Mistake 2, mixing investing and trading. You buy for the long term. Then panic sell in a short-term drop. Or you enter for a quick trade. Then hold a loser for years hoping it recovers. How to avoid it? Keep separate strategies, separate money, and separate rules for investing and trading. Mistake 3, overtrading. You keep buying and selling every few days. You chase action. You rack up fees and taxes. Your returns suffer. How to avoid it? Trade only when your strategy signals a clear opportunity. Mistake 4, chasing hot tips. You hear a stock name from a friend or TV. You buy without research. You trust someone else's conviction instead of your own. How to avoid it? Use tips only as a starting point for research, not a reason to act. Mistake 5, ignoring risk management. You put too much in one stock. You don't set stop losses. One bad move wipes you out. How to avoid it? Diversify smartly. Set position limits. Protect your capital first. Mistake 6, letting emotions rule. You buy from greed. You sell from fear. You ignore logic when emotions are high. How to avoid it? Follow your plan in both good and bad times. Mistake 7, not learning from mistakes. You lose money, but you don't review why. You repeat the same errors. How to avoid it? Keep a trading journal. Write down what worked and what didn't. Mistake 8, overconfidence after wins. You think you can't lose. You take bigger risks. The market humbles you. How to avoid it? Stay humble. Respect the market at all times. Mistake 9, ignoring costs and taxes. You focus on profit before costs. Brokerage fees and taxes eat into gains. How to avoid it? Always calculate net returns, not just gross profit. Mistake 10, unrealistic expectations. You expect to double your money in months. When it doesn't happen, you get frustrated. You quit or take reckless bets. How to avoid it? Set achievable goals. Focus on consistent returns over time. Mini case study. Suresh jumped into the market without a plan. He followed TV tips. He traded daily. After a year, his account was down 40%. He stopped, learned risk management, and built a simple strategy. 2 years later, he was profitable and consistent. Checklist before any trade or investment. Do I have a written plan? Am I risking too much on one position? Am I acting on my own research? Have I calculated costs and taxes? Am I prepared to follow my rules? Reminder, mistakes are lessons. If you learn from them, if you ignore them, they will repeat. The market will test you again and again. Your job is to get wiser each time. That's how you turn experience into profit. Chapter 11, Regulation, Compliance, and SEBI. The market is not a wild jungle. It has rules. In India, SEBI, the Securities and Exchange Board of India, makes those rules. They protect investors. They keep companies honest. They punish fraud. Every broker must register with SEBI. Every listed company must follow disclosure norms. You should know your rights as an investor and your responsibilities. Regulation is not your enemy. It is the guardrail that keeps you from falling off the cliff. Chapter 12, Taxation and Real Returns. Making money is one thing. Keeping it is another. When you profit from stocks, taxes apply. Short-term gains are taxed differently from long-term gains. Dividends have their own rules. You must track your transactions. You must file them correctly. Ignoring taxes can cost you penalties. Also, remember inflation. A 10% gain may be less in real terms if prices around you rise. Always look at real returns what you keep after taxes and inflation. Chapter 13 Case Studies and Real Examples. Theory is one thing. Real stories are another. Some investors turned small amounts into fortunes. They bought strong businesses early. They held through storms. Others lost it all. They chased hype. They ignored warning signs. Studying real cases shows you patterns. What works? What fails? It makes the lessons stick. It turns abstract rules into living, breathing examples. Chapter 14 Putting it all together. Now you see the full picture. You know what the market is. You know who plays in it. You know how to set up your tools. You know how to read businesses and prices. You know how to choose a style. You know how to manage risk. You know how to control your mind. You know the rules. You know the traps. All that remains is action, small, careful, patient action. The market is a journey. You learn as you walk. You grow as you stay. Outro: the Indian stock market is not a shortcut to riches. It is a long road, a road where knowledge is your fuel, discipline is your steering wheel, and patience is your seatbelt. You will have good days. You will have bad days. But if you stay steady, the journey will change you. Not just your wealth, but your mind, your confidence, your way of seeing the world. So step in, not with fear, but with awareness, not with greed, but with balance. Your future self will thank you.